Thank you very much, Chris. Good morning, everyone. It's really refreshing coming from the professional background that I come from to be in front of a crowd where I can simply say good morning, everyone, and not have to go and say distinguished delegates, excellencies, and so on and so forth. This is closer to home for me because I used to teach at a university some time ago, and hence my interest in research. As Chris said in his introduction, I am also part of the Southern African Institute for Policy and Research. And it was in this context that this study was actually born. I mobilized a team of sort of like-minded people, and these used to be my students, and we started to try and toy with the idea of studying the efficiency market hypothesis. Essentially, what I'll try to do is explain a little bit more the motivation, particularly because the efficient market hypothesis does not easily lend itself to a policy context. It's really about distinguishing which markets are efficient and which ones are not in a certain sense. And coming back to this conference, which looks at development financing, I think we had to change the expectations a little bit and pitch some parts of the study in the light of the symposium. So I will talk to some of the competing expectations. I will also look at some of the empirical observations by other people that have studied the subject matter, and then I'll look at some of the preliminary observations from our study, and then I'll conclude by looking at the way forward. The motivation for us was really the award-winning work by Farmer, which won him the 2013 Nobel Prize in Economics. And a few of us, the group that you saw in the earlier slide, had been sitting on this idea of trying to model efficient market hypothesis and test that hypothesis for African countries. And I think Professor Thorberg yesterday started to explain a little bit about the idea behind efficient markets. And he explained it in terms of a random walk process. Essentially, the idea is if a market is efficient, any information that concerns the market, such as, for instance, a CEO of a company resigning or something like that, should very quickly translate into a change in the price. And that's what you would see in an efficient market. And anything less than efficient means that there's inertias in the extent to which the information is translated into the price. So this is basically what we're going to try and test for a number of African countries. And the purpose was really to make a modest contribution to the literature, particularly bringing in an African perspective into testing efficient market hypothesis. Now, I work for COMESA, so when I was getting my clearance from my boss, the Secretary General, to do the presentation, he starts to ask me, so what are you presenting on? And I explained to him, I'm trying to distinguish which markets are efficient and which ones are not. And then he says, okay, so after you've flexed your econometric muscles, so what? And I didn't really have a good answer for him. And he started he's a provocative man, and he started to provoke me a little bit and ask me, okay, are you going to get to the crux of what are the factors that drive efficiency for any market? What are the factors that drive performance of a market? Is there any feasibility in thinking about using these markets at either a national level or a regional level to support development, infrastructure development, and things like this? So it really threw a curveball at me, and for a time I was a little bit discouraged, and I wrote to Professor Muna, and I say, Prof, I gave the excuse that the data were getting difficult to collect, and I said we might not make it for this presentation. And Prof, being the gentleman that he is, being the scholar that he is, he says, look, you are not expected to always have a refined, final, finished products. Let's bring something for debate and bring something that is relevant to the symposium. So that gave us a new lease of life, and we continue with the research. But we decided for this presentation to change a little bit the focus. Instead of looking at the results, which are really still work in progress on the testing of the efficient market hypothesis, is to look at some of the background work that we have already done in terms of literature review and in terms of some of the descriptive work that we have done. I'll just quickly go through the literature review aspects, and what we noticed is the results from the different studies that were done on Africa, looking at different samples of African countries or African stock markets, are quite mixed. And they seem to be very sensitive to the choice of estimation methods. Not surprising there, the choice of variables, whether you're going to use a price index or you're going to use individual stock prices and daily trades and things like this, and also sensitive to the data and the way the data are handled. I must say for my team and myself, it's been quite a challenge to tap into these stock markets and get the data. So Chris is now my new best friend because of his success in getting micro level data. Hopefully he can give us a few tips on how to get into the stock markets and get information. So going back to where we started from with this work, we had overly ambitious ideas. We were going to look at all the 29 African stock markets. Clearly, we've toned down our ambitions after getting to the realities of the data. We're trying to find daily stock prices and daily trades. And there are a lot of data challenges with not just getting into the institutions that house these data, but also the characteristics of the data themselves. And because the data collection has gone a little bit slowly also, I decided to take out the preliminary results on the autoregressions and things like this. So I thought maybe we should focus a little bit more on some of the characteristics that might help us to raise the debate a little bit about the relevance of stock markets for development. And some of the things I'd like to look at from our background readings and from our literature review is really look at these characteristics in terms of the emergence of stock markets in Africa. Also looking at the size and the trading processes or systems of stock markets. Get a sense of what the trading rules and restrictions are, as well as look at the regulation and some of the risks inherent in the structures of some of the stock markets in Africa. And then finally look at some emerging issues in relation to global integration and regional integration. So in terms of emergence, out of the markets in Africa, we were able to get information on 25 countries, and the summary, the highlight in that slide is really that most stock markets appear to have emerged around the 1980s to 1990s. Some authors have suggested that this has to do with the structural adjustment programs of the IMF and the World Bank at the time, which sold the idea of stock markets as a vehicle for potentially privatizing state-owned enterprises. We do have some fairly old stock markets in Africa, some dating as far back as the 1800s, and we do have some really young ones, such as Seychelles and Somalia, that emerged in 2012. In terms of the size of African stock markets, they are really quite small. We did get aggregate data, annual data, and one of the indicators that is used to look at the size or the value of stock markets is the market capitalization, the market cap. And for 16 economies in Africa, we found that the annual average market cap between 2003 and 2012 was around $787 billion. But this is largely attributed to a dominant stock exchange, which is the JSE, the South African Stock Exchange, the Johannesburg. If we net that out and focus on the remaining 15 economies, the market cap, the annual average drops to 13.8 billion. In striking contrast, if you look at the New York Stock Exchange, the market cap is estimated by some authors as being in the region of $16 trillion. So it's more than 21 times larger than an average African stock market, if you include South Africa, and more than 1,200 times larger than a typical stock market if we exclude South Africa. So this really starts to tell you, where the world's capital is and where it isn't. Clearly, it is not in Africa. And in terms of the numbers of listed companies on these stock exchanges, again, other than three somewhat outlier economies that have done relatively well, at least over the time period that we were looking at the stock markets, most African stock markets seem to be clustered at less than 90 listed companies over the time period. There seems to be a story for Egypt. I'm not sure what the delisting is about, whether it's the political instability over the time period. I'm sure colleagues that are more conversant with that economy would help us explain that downward trend. But the bottom line is in terms of numbers as well of listed companies, the stock markets in Africa generally are small. Then in terms of their size relative to the economies, again, comparatively small except for two outliers, South Africa and to a lesser extent Zimbabwe, where the market cap as a percentage of GDP are larger than 100%. For South Africa, it's actually 205%. The stocks traded as well, nothing impressive except for South Africa and to a much lesser extent Egypt in terms of stocks traded as a share of GDP. So you can see that, again, the amount of capital that is available in the stock markets in Africa is relatively small. What sort of processes do the stock markets use? The majority of the markets that we have seen, and in this case we're looking at 22 markets, is they run a daily trading system where they trade for hours in a day, various hours in a day, from Monday to Friday. There are other stock exchanges in Africa that operate. There are fewer that operate Sunday to Thursday, and I think there's a sort of religious historical reason for this. Is the Islamic countries generally operate Sunday to Thursday, whereas the secular and Christian inclined states run their stock exchanges from Monday to Friday. In terms of the systems that are used to run the stock exchanges, many of the countries have migrated to various levels of electronic trading. We found the Johannesburg Stock Exchange to be the most sophisticated, and some authors have actually claimed that it matches the system that is operated under JSE matches what the London Stock Exchange uses. The study at this point was still yet to establish whether there are still some countries that operate call over or open outcry systems. But I think one of the take-homes in this slide is fundamentally the investments in a stock market's trading systems support the improvement in liquidity, the amount of trade that goes on, and greater efficiency of the market, informational efficiency. This is something, obviously, that this study has not proved empirically, and is something that would be interesting to pursue and see what are really empirically the determinants of market efficiency, beyond just looking at which markets are efficient and which ones are not. In terms of trading rules, again, and costs and restrictions, particularly on foreign participation, we looked at 19 markets. And again, there's a varied picture across Africa. In terms of withholding tax, out of the 19 markets, we found 11 that apply various withholding taxes on interest rates, dividends, and capital gains. The taxes ranged from 10 to 15%. Just out of interest, we started to think, what about the taxes on pay as you earn on wages? When you think of a person's labor as their asset, which they get a return on in terms of a wage, a number of these countries apply pay as you earn that as high as 30 to 35%. So basically, the system that's being created is one that sort of protects the have-nots in terms of taxation, and taxes more heavily, protects the haves and taxes more heavily the have-nots, the people that are wage earners or income earners, but people that are able to participate in capital markets are relatively more protected in terms of taxation. In terms of commissions, the ranges were from 0.5% to 2.5%. Foreign participation restrictions exist, but they are not highly prevalent. We only found them in 7 out of the 19 markets that we observed. Some authors have argued that the trading rules, the costs, and the restrictions are really part of the bigger picture in terms of the reasons why portfolio inflows of capital into Africa are low. There are other aspects that I'll get to in a moment. I think a take-home for us again was we probably need to be a bit more systematic in looking at these rules, looking at these costs and restrictions, and trying to figure out a way of actually estimating quantitatively what their influence is on the efficient operation of markets. In terms of regulation, most markets are regulated by an independent commission or a committee, but there are some that are regulated by a government agency, a central bank, or a finance ministry. An interesting observation by some authors is that many of these stock markets in Africa really emerged on the back of poor regulation and poor legislative frameworks, and I'm sure the legal people will relate to this and the importance of, if you're going to get the economics right, having a sufficient legislative basis. And some authors have argued that this is part of the reason why risk-averse investors have not brought their capital investments into Africa, is because investor protection is low without the right legal framework. Market credibility, market confidence, and things like this are all compromised. Other risks obviously include foreign exchange risks, political risks, and so on. And all these have a role to play in the performance of markets. Again, other authors have looked at the extent to which African markets are integrated into the global economy, and some opinions are that they are not sufficiently integrated, and on that basis, the few investors that are willing to take the risks are only willing to take the risk on the back of high expected returns. The expected returns were estimated at 18.4% by Urban and others, and this is fairly high. But all the same, the responses have not been that great in terms of portfolio inflows into Africa. On the other hand, some authors say maybe it's a good thing because the lack of integration insulates African stock markets from crises, and they therefore offer a good option for portfolio diversification. Again, another question raised while we were doing the study is what is an optimal level of integration into global markets for Africa? Finally, on the back of some political push to establish stock markets, regional organizations have also gotten in on the action, but without much success in terms of creating regional stock exchanges. The Africa Stock Exchange Association has had a long-term plan for some time that has not really yielded anything. SADC has been trying without much success. COMESA has provisions in the treaty, but until recently had not tried. From our readings, what we found was only 2 stock exchanges at a regional level, which were in West Africa, the West African Stock Exchange and the Central African Stock Exchange. And I must confess, I'm not very conversant yet with the operations of the Central African Stock Exchange. Just as a way of sort of broadening the thinking about what potential contribution stock markets could have for financing development, COMESA has been toying with this idea about innovative financing for infrastructure, and one of the things that they looked at as an institution was is it feasible to use a common market levy for trade in goods? So for imports that are coming from outside the region, is there a way of introducing a levy? And this has sort of political implications and tensions. And another option was to use the same thinking to think about stock markets and say, is there, if COMESA can make a contribution to fixing the legal framework and making it enforceable, to fixing the performance, increasing the number of stock markets that get created, number of listed companies, the liquidity and things like this, is there scope for thinking about then charging a sort of royalty or commission for this service, which would then be used as revenue for infrastructure development, for instance? And of course, there are a number of aspects that arise if we use just the numbers that we had to look at. It is feasible, and you would notice at the bottom of the table the amounts of revenue that might be generated on an annual basis. Nothing overly large, but when added to a resource pool of resources, even $62 million or $33 million could be an important contribution for infrastructure development or services development at a regional level. But of course, there's a lot of work that would need to be done to, first of all, clean up and fix up the regional environment. And there is also this aspect of the regional equity in terms of the revenue generation. In this particular table, you'll notice that the bulk of revenue generated would be from the Egyptian stock market, and the other stock markets, because of the limited performance in terms of stocks traded, would not be contributing as much. So at a regional level, it would be figuring out how to convince Egypt to bite that bullet, so to speak. In terms of the way forward, we expect to finalize our study on efficient market hypothesis testing by August, having collected 60% of the data and hoping to collect the rest by the end of June. But really, I think being quite honest, the results do not seem like they would lend themselves to very robustly to a discussion of development financing when you look at the context or the design of efficient market hypothesis testing. So the questions, some of which have been raised here that relate more to policy, asking about legal frameworks and things like this, will remain largely unanswered within the purview of the paper that we are developing. But there is hope that we will try and organize these thoughts and with our newfound friends at Cornell and other people that we have met, leaning on CYPA, there is every possibility that we'll start to interest people into looking at the determinants of market performance, stock market performance, and hopefully work out more policy informing or policy relevant results. This is all I had for you. Thank you very much for your time.